Welcome back, Peter.
Thanks for having me on.
I'd like to start off with the greenback. The stealth dollar rally that started last year seems to be winding down, along with the hubris over deflation. Meantime, West Texas Intermediate crude and precious metals seem to be telegraphing signals of the reemergence of the inflation trend.
People maybe didn't notice it because of some of the deflationary forces that temporarily had the upper hand. But once the deleveraging was over, once that initial shock wore off where you had that money fleeing to dollars as it was fleeing assets, I said at the time it was the head fake. It was kind of like a running back. He's going to go right, but before he goes right, he fakes left, and he kind of, gets the defense going the wrong way. Well, that's exactly what the markets did. They got everybody going chasing deflation, and now you've got the running back running straight for the end zone on the inflation. And everybody's, flat-footed now. People now have to rush to get out of the defensive deflation trades, which were dollars and treasuries, and now they're rushing to get back into commodities. They're trying to buy oil, they're trying to buy copper, they're trying to buy gold, they're trying to get into the Aussie dollar or into other currencies, and you're seeing these trends. And, you're looking at bond prices dropping like a stone and commodity prices rising.
Better than expected economic reports, they seem to be the rally cry of the bullish investors.
Economic reports that are less horrific than people have feared. It's like, if you're expecting your son to bring home an F and he's got a D on his report card, it's no reason to start celebrating and, buying him a new car or something because he didn't get an F, he got a D. And the thing is, just because the numbers are not quite as horrific as they used to be, doesn't mean that the economy isn't going to keep worsening. Like we just had the last payroll job. We lost 350,000 jobs instead of the 500,000. We're still losing a lot of jobs. More people unemployed than the month before. And there's nothing that says that those job losses aren't going to continue. Even 350,000 jobs is a lot of jobs to lose in 1 month. And, of course, who knows what the government is going to revise it to next month. It could be over 500,000 for all we know.
So you're not buying this argument that although we are at 9.4%, approaching double-digit, 200,000 better than expected, any way you slice it, it's still bad news.
Yeah, look, all the news is bad. And remember the source of all this news is the government. And I don't even believe these government statisticians. A lot of the way governments calculate economic data today is flawed. I mean, they have it so it has a bias to making the numbers look better. Even if you look at how they report unemployment, they don't report the people who are discouraged and no longer looking but really want jobs, and they don't report the people who, have taken part-time jobs that really want full-time jobs. I mean, you got an engineer who's unemployed and he gets a part-time job, as a fry cook in McDonald's. All of a sudden that guy's not unemployed. But of course, he used to make $70,000, $80,000 a year. Now he's making minimum wage. The guy's obviously unemployed. But if you count those two groups, you're looking at unemployment right now at 16%. That's almost depression era. The government constantly, one of the first things that politicians do, presidents, when they get in office, is they change the way you keep score of the economy. They change the way they calculate the statistics. That way, the president can always claim that his policies improve the economy. When there isn't any real, genuine improvement, there's just, it's just like grading on a curve. All of a sudden the teacher grades on a curve and students can go from C students to A students, even though the students aren't getting any better on the exams. They're just grading them on a curve. Now the teacher can claim, well, look, I improved everybody's grades.
The markets appear to be working off a solid year of extremely bearish sentiment. And it looks as though the pendulum had swung a bit too far on the negative side. We've seen some momentum come back into stocks. There's more of a bullish stance on equities. Do you think this is going to be a sort of 1929 to 32 bear market rally?
Well, I think, look, we've been in a bear market the way I measure stocks since 2000. So this is already 9 years into this secular bear market. We're probably not even halfway through it. And, what I'm looking at is, in terms of the price of gold, in 2000, the Dow was worth 43 ounces of gold. It was an all-time record high. Today, we're worth, I think, under 9 ounces of gold. And I think that this bear market is going to continue for the next decade at least. And by the time the U.S. stock market bottoms in terms of gold, I think the Dow will be back down to about 1 ounce of gold, which is where it was in 1932 and 1980, at both of those prior peaks of secular bear markets. And, what the nominal level of the Dow is going to be when that happens, there's no way to know. It could be Dow 5,000, gold 5,000. It could be Dow 10,000, gold 10,000. Or it could be Dow 20,000, gold 20,000. it doesn't really matter. All that matters is the real value of stocks. Nominal values mean nothing.
You know, I'd like to switch over to the credit market and the credit crisis. We saw the whole industry crack up last year, and now it seems to be losing favor. We don't hear a lot of talk in The Economist and other magazines about the credit crisis, but there's still a lot of negative news coming down the pike. Credit card companies cutting back on credit limits, plus there's also this mountain of Alt-A's, somewhere near $2.4 trillion that have not yet begun to reset and will do so later this year and 2010. Do you think that this could lead to another credit crisis as more of these mortgage-backed securities and SIVs implode?
Of course, and some of these financial institutions that are paying back their TARP money. And we're saying, hey, look, everything is great. I mean, first of all, not everybody is giving back their TARP money. But the only reason a lot of these companies are able to give back their TARP money is because the government changed the accounting rules. And so now they can pretend that they're solvent when they're really not. And I think as a lot of this new debt comes due and a lot of these mortgages reset, these banks that are paying back their TARP money in a year or two are going to be back to the government with their hat in the hand again looking for another bailout. Because there's a lot more shoes to drop in this thing. This is a centipede.
So you're not giving a lot of weight on the 345,000 job number. I mean, you think this could actually turn around and begin to reaccelerate?
First of all, the problem is the government is interfering with the market, and we're not creating the jobs that we need to replace the jobs that we are going to lose. There are millions of jobs in this country that are going to go away. They're jobs that never should have been created in the first place. They only existed because of the consumer spending bubble, the housing bubble. And when you take all that spending out of the economy, all the jobs that it supported also go away. But if these people are going to go from the service sector to goods production, if they're going to have to stop working in malls and start working in factories, we have to allow capital to be reallocated. We have to allow these factories to be built so that these people can have productive employment. If we just try to keep them in jobs that aren't productive and then government makes up more non-productive jobs, we're going to destroy the economy completely.